tonight, we're going to do a few things. First of all, we're going to finish the Chapter 3 handout. And we'll have the Chapter 3 multiple choice questions, kind of like we did for Chapter 1 and 2. And the Chapter 3 exam will be emailed after class. It will be due on Friday 25th. So not this Friday, but the following Friday. Then we're going to start into Chapter 10, and this is on cash. So from here on out, we should be doing more of the, not so much the theoretical stuff, but more of the actual steps in auditing. How do you determine whether the financial statements are misstated or that sort of thing. Okay, so I think let's go ahead and just jump right into the Chapter 3 handout. I think we're on independence issues. It should be somewhere around page 6. I'm not sure how my spacing is here. It might be before or after page 6. But independence, other independence issues. Okay, let's just jump right into these. Past due professional fees. Okay, if all right, past due fees. Yeah, so if you have done audited work for the client and they have not paid you, at that point you are no longer independent. It's basically that it's almost like you give it a loan to the client. It's your investment loan. In other words, and you have a vested interest in how well the client does now, because if they don't do well, they won't be able to pay your fees that you have loaned them, basically. So if there are past due fees, you are no longer independent. You can't do the audit. And they can get somebody else to do the audit, but you are no longer independent. Gifts come in kind of two forms. First, they should be clearly immaterial. And this goes for them giving you gifts or receiving gifts. So they should be clearly immaterial. And now they don't really go by the IRS guidelines, and the IRS will give a dollar amount. I forget what it is, $40 or something. But anyway, it's just that they must be immaterial. In other words, they wouldn't be enough for you to make a rational person, to change to become biased. Now there is a second one though, a second form that can be a little bit more troublesome. I like to call this the golfing rule. Appropriate in a given circumstance. And this comes into play for something like a lot of times they'll have golf outings, and these golf outings they can be really expensive. But a lot of times they'll have company golf outings, something like that, and a lot of times the auditors get invited along. It might kind of comes as a surprise as auditors are a lot of times kind of considered as not this, you know, standoffish kind of person. Is that they're often considered, you know, someone they can go to if they have a problem, if they need, you know, if they need guidance on something and that sort of thing. So a lot of times they'll get invited to, you know, something like a golf outing. Now these golf outings, they could, you know, the fees for them can be thousands of dollars, clearly material. And so, but in the circumstance that this is a company golf outing or whatever, it's appropriate. So there's kind of this other thing, you know, I always call that the golfing rule, because that seems like it's always where it always comes up. But either clearly immaterial, or that it's appropriate in the given circumstance. Litigation. This also comes in two forms. Litigation between the auditor and the client. So if there's litigation between the auditor and the client, that could also impact independence. Oops, what is what's going on here? The second one is litigation between clients. So, you know, client one sues client two. So you got to remember that you know you have this confidential information. You have a fiduciary duty to your clients. If one client's suing another client, you know you're looking at confidential information for both of them, and that information might be something that one of them wants and the other one wants or whatever, and you can find yourself in the middle of that. So it is possible that even though your firm and yourself are technically independent from each of those clients separately, because those two clients are suing each other, you may have a difficult time struggling. You may decide that you're not independent and that you know, will have to give up one of the clients. But now the one that's obvious is if the auditors are suing the client or the client suing the auditors, well, then it's kind of a, you know, it's kind of surprising that you're still working as their auditor. But I am going to wait on this one. Yeah, this is at the end. I don't know. I should take this out. I'll show you why I'm waiting on it, because there's a whole section on it. This last section, the whole thing is on it. So rather than bore you twice, I'm only going to bore you once with it. Reporting illegal acts, I think we've already talked about. This is the same as we had before. Oops. Yeah, the illegal acts is same as we had before. I'll open them up again just for kicks. Illegal acts. Oh, I want to talk about some of this too. Okay, reporting illegal acts. PCAOB. If no action taken. This is exactly the same as we had before. There's no. I do want to mention one thing, that this goes back to the test, and that is, and this is like the difference between real life and the AICPA exam. And a number of you, and incorrectly so, is when I think I had one on there about the illegal act that was immaterial. And you say, well, do some more investigation, see if it's widespread, see if, that if it's just one person doing it or is it many people and all this kind of stuff. In real life, that's exactly what you do. If you're answering this for the on the CPA exam, if they say it's immaterial, take it as that, but it's immaterial. Now, in real life, yeah, you would definitely investigate further and get more into it. But if they ever give you facts and they say that it's immaterial, just assume that it is. Right? And the reason I say that, because one of the things that they, what you should be careful of is not actually answering the question. While what you're saying is actually true, it doesn't necessarily address what they're getting into and what they want you to know. Okay. Subpoenas. Work papers isn't a word. I think it is a word. Okay, the auditors use the work papers as evidence for their opinion. Okay. So the auditors, they get all this information on the client, it's in their work papers, and those work papers are owned by the auditors, not the client. The auditors own the work papers. It's their evidence. If they ever get dragged into court, they're gonna pull out this evidence and say, look, we did this, this, and the other thing. Okay, now, a lot of times you'll have the client might be getting sued by somebody. Or it could be a criminal investigation or whatever. You only turn over anything in those work papers if there is a valid subpoena. It can't be just a letter from a lawyer. It can't be an exploratory, a lawyer asking for exploratory information for a lawsuit or something like that. If they have to go to court and get a judge to approve a subpoena, a legal subpoena, before you can turn those the work papers over. And you have to comply with that. Almost all the states have you comply with that. There are some states that limit it, but for the most part, you have to comply with a valid subpoena. You must comply with it. But now only a valid subpoena. Law enforcement sends you a letter and they want this information, forget it. You got to get a subpoena, or a judge get a subpoena, and then they can, once they present you with a valid subpoena, then you can comply with it. But even though you own the work papers, you can't just, post them on the internet. It's still confidential information, and you still need to treat it as such. Now, it's not privileged, though. It's not like between a client and a lawyer. A client and a lawyer, no one can get that information. It's completely off limits. You can't, even in a murder case, you can't figure out what, ask for what the lawyer talked to their client. But it's not like that, but you need a valid subpoena. And only for what the subpoena is for. Okay, there is one notable exception to the rule, and that is and this can be done without the client's note agreeing to it. You may have somebody come in and review the work papers. It could be, there's the PCAOB has specialized reviewers that can come in, independent ones. It could also be reviewers from the AICPA that come in, but people that review the work papers, those people are granted because they can't do the review of the audit without it. So even though you contract with your the partner in charge, and that partner is the one that is handling with the client. There could be another partner or someone similar in a similar position that comes in and reviews them, even though the client doesn't have any contract with the other partner, because it's in a review situation. It's basically related to the audit or the quality of the audit given, but that other people that review the audit also have a right to see the information. Again, because they're not because necessarily they have an interest in the client or it's a lawsuit or anything like that, but because it's part of the quality control to make sure the auditor is done correctly. Okay, I think these are the same questions we used before. Auditors uncover evidence that the publicly traded client routinely violates Environmental Protection Agency laws and presented with this evidence. The board did not respond. Okay, it's publicly traded. And so this falls into the 24-hour rule. But we did this before. Turn it over to the SEC. And down here, CEO parks illegally. Well, it's despicable. We do nothing, not material. Okay, contingent fees. Contingent fees are dependent on some outcome. So something is causing the it to be contingent upon something else. Let me put something up here. Flat fees. Regular flat fees are always allowed. So if it's a certain amount of, you say you're going to do this for $10,000, you can do it for $10,000. That's always allowed. Contingent fees are contingent upon some outcome. It says contingent on. It's sort of like if someone asked me, are you going to use them? Are you going to when you leave home? Are you going to take an umbrella with you? Well, I'll take an umbrella with me if it's raining, right? So the decision about the umbrella is dependent on, is contingent on if it's raining. If it's not raining, I'm not taking an umbrella. So contingent fees are the same way, that if something happens, then you get paid or get paid more. Right, so if this happens, you get paid more. So, for example, somebody say, you're doing an audit for a client, and you say, they say, how much your fee is? Your fee for this audit? You say, okay, it's $90,000. Client says, I'll tell you what, if you give me a clean audit, I'll give you an extra $10,000. I'll make it $100,000. If you give me a clean audit, I'll give you $100,000. Now notice that extra $10,000 is contingent on the outcome of the audit, right? So the question is, well, when can you use those? And basically, you can always do a contingent fee, but there are 3 exceptions to it. So contingent fees are always allowed with 3 notable exceptions. Except for, like our qualified report. Oops. Audits or other attestations. So these are not allowed. Tax returns. Okay, so you can't have a contingency fee for an audit. So if a client says they'll give you $10,000 extra, you can't accept that. You say, no, 90,000 is the fee. Also for taxes. Yeah, it says as a CPA, if you do some of these taxes, you say, okay, I tell you what, you don't have to pay me any money up front, but whatever your refund is, I'll take 20% of your refund. Notice that the fee is dependent on the refund. Okay, so that's also not allowed. So you can't do it for audits. You can't do it for taxes. Now, do people do that for taxes? Yeah, they're not CPAs. If you're not a CPA, you can do that. You can say, okay, I'll do your tax and take 20% of your refund. They say, okay, you say, okay, and that's it. But if you're a CPA, it's a no-no. And the third one is a oops, let's get a number here. Okay, compilations we have not talked about. It's a compilation. It's an excellent question. Hey, look, I got my pointer. I got this at the dollar store. I make a point. Actually, I got it. All right. So making the point about compilations is that compilations are when you agree to do the financial statements for somebody. This is for a client that doesn't need an audit or anything, but they need to get their financial statements. For instance, let's say they own a photography studio, and they don't know about accounting, don't have any interest in accounting, but they want to know where they stand. Okay, can you make financial statements for me? You say yes. They give you the information and you compile it into financial statements. So you take their information and simply compile. Now, whatever they give you, that's what you put in, and you don't audit it. Whether they give you crazy stuff, they're going to get crazy financial statements, but it's not your business because you're just taking their data and putting it into financial statements. Now, if you're doing a compilation for somebody and they're going to use that for a loan or something along those lines, you can still do the compilation for a set fee, but what you can't do is they say, okay, you do this compilation, and I tell you what, if I get a loan, I'll pay you an extra $3,000 if I get the loan from the bank. You can't take that. So if it's a compilation where you're simply taking their financial statements, financial information and making financial statements, you can't take that. Now, these three exceptions, those are the only three. You can have a contingent fee for other things. So for instance, if you're putting in a security system for a client, and they say, if you get the security system in by July 1st, we'll give you an extra $10,000. You can take it. It's not an audit. It's not doing taxes. It's not a compilation. So you can do contingent fees are not by themselves, there's nothing wrong with them. But those are the three exceptions. The three places you cannot use those are audits, tax returns, and compilations. So these are the three no-nos. Just left here. Oh, not too much. Okay, good. All right. X discreditable. It's gonna be a lot of things. The three things that come up routinely are committing felonies, that is a discreditable act. Not filing your taxes. That's a act discreditable. Disclosing CPA exam information. As odd as that sounds, these are probably the three most common that you'll see come up in the CPA exam. By the way, all three of those will also get your license yanked. So you won't just get kicked out of the ACCT433. The state will usually go after you for those, unless there's some weird circumstance. But yeah, so a felony will get your license yanked. Not filing your taxes, that's one of the ones that's kind of strange, but if you don't file your taxes, the state can actually take your CPA license. And the third one of the CPA exam questions, that's by both the ICPA and generally the states too, that disclosing CPA exam questions is a no-no, and that can also get your license changed. When students take the CPA exam, like for instance, I'll never ask them exactly what the questions were. You can ask general questions like what was covered, basic areas, but as far as the actual CPA questions, what the actual CPA questions are, you can't do it, and you shouldn't disclose those either, what the actual ones are. It's to uphold the integrity of the exam. It's kind of strange because I say back in my day, they would actually send you the exam. You could have email or not email. They didn't have email. They would snail mail you the exam that you took. You'd have all the questions there, but they don't do that anymore. And they're very diligent in guarding the CPA exam questions. All right. Referral fees. Not allowed for audit engagement. So if you're doing the audit, you cannot charge, you cannot have referral fees. Other services may For other services, they are allowed if they are disclosed to the client. So if the client is, so if you're doing the audit and the client says, you know, I need to get life insurance. Do you know anyone who can sell me life insurance? You cannot offer to send them to anyone on a referral fee basis. So you can't set a referral fee. Now, suppose it's not an audit. Suppose you're doing some other service for them, bookkeeping, bookkeeping for them. They say, you know, I need life insurance. Can you send me something? You say, yeah, you know, this is the person that I, sell life insurance. Now, I got to tell you, when you go to this person, that they give me a fee of $25 for every person that's referred to them. So as long as you are upfront about the fee, it's fine. If it's not an audit or a attestation is probably a better term. If it's not any, if it's not any of the, along the auditing genre, you can do it, but you must disclose it to them, and you must tell them, look, I get, this is the fee I get. So you can do it, but it must be disclosed. CPA is a tax advisor. I think I get that down here. I should clean this thing up because a lot of them come down here to this. Yeah, let me do it down here. Skip this one. So you skip. See below. Okay, but this is a comparison of Sarbanes-Oxley and the AICPA. Now, these rules that we're going through are only for auditors. If you're a CPA firm and you're not doing the audit, which is fairly common, you might be doing work for, say, IBM, and you're not the auditor. And actually, you'll kind of see why when we go through this. There's no problem. But if you are the auditor, there are a lot of things that you can't do, especially from the PCAOB, for the client. Now, the one overriding thing that both of these have, though, is both the PCAOB and the ACCT433 are very diligent in that you should not do any management tasks, that you should not do any management activities. So you cannot do the management of the company. And they're very clear on that, that it's not allowed for you to make managerial decisions. Okay, so PCAOB, now this is for issuers, publicly traded. And this is generally aimed at non-issuers, although they also apply to PCAOB a lot of times through state laws and stuff like that, for the same same CPA firms. Okay, bookkeeping. No for the PCAOB. Yes for the AICPA. Now that may sound odd, but for routine run-of-the-mill bookkeeping, a CPA firm, if it's not publicly traded, can do the bookkeeping. They cannot approve journal entries that go into the ledger. That's a management job, is to approve journal entries, but they can make the journal entries and then have management approve them and post those into the general ledger. But the CPA firm can actually do the bookkeeping, can actually make the journal entries, and management will approve those going into the financial statements. Financial accounting system installation, financial order accounting system installation. No. ACCT433? Yes. It used to be routine to the point of automatic that when a company needed a new accounting system, the CPA firm would install it. Publicly traded companies. The problem is, and here's what the PCAOB, here's what they kind of crack down on, is that you cannot audit your own work. I know it sounds obvious, but the point is, if you put in an accounting system and then you go in and do an audit, and you're auditing, a good part of your audit is on that, that accounting system, that you are biased, right? You're not going to come out and say, well, this accounting system is garbage, because you put it in, so and again, this was routine that virtually any publicly traded company, when they needed a new accounting system, would call on the auditors would come and install it. That's no longer allowed. Now, for the ACCPA, for a smaller firm, yeah, you can. Generally speaking, if it's off the shelf, and that is that it's not a accounting system that you made up, and I don't know why you would make up one, because they're a couple of $100. Yeah, you can buy ones that are pretty powerful. So anyway, if it's an off the shelf package, you can install it for the client. Is not a problem. Okay. Appraisals or valuations? No. And no. The only way that you can do appraisals or valuations from the AICPA is if they have very clear non-judgmental criteria. For instance, if they ask you for a valuation of stock, they owned whatever, they own Ford stock at the end of the year. Well, very objectively, you can go to the Wall Street Journal and see what the last price paid for Ford stock and say, that's it. So if there's no judgment involved, then you can do it, but generally not if there's judgment involved, especially. Internal audit functions, no. And yes. This is one of those things that'd be hard to imagine a company doing it. I guess they do sometimes, but it's so much cheaper just to pay, your own people rather than have the external auditors come in. But I guess some places do that. Management or human resource recommendations? No. No. Investment services recommendations? No. And this one is yes, but with a big asterisk. You cannot make specific investment picks, for instance, for stocks or bonds or whatever. You can tell them general allocation, that, okay, you should have 20% of your money in tech stocks and 20% of your money in energy stocks or something like that. The general, allocation of it, you can give general advice, not specific advice as to, oh, buy this stock, oh, buy this stock, that kind of thing. All right. Legal services. Oops, sorry. Yes. And yes. This is odd in that it's a yes by default. It's not a yes that's granted to them, but they don't have any rules on it. Now, all those services must, there are rules about how you perform services and stuff for your client, but actually saying that whether they can do legal services or not is actually, they're silent on those rules. So by default, it's yes. Tax planning common issues, yes and yes. Tax planning for unusual or aggressive issues, no and no. Change that. CPAs cannot be advocates for their client. You cannot advocate for your client, which is what you'd have to do if you were in a, if they took an aggressive or unusual tax position and they were, say, arguing with the IRS, you'd have to go into court basically on their side. You can't do that. You cannot be an advocate for the client. And to some extent, I mean, the client, and now not just in this, but in other instances too, the client might tell you, hey, I got to meet with my banker next week. Can you come in and tell them, that we're a good company and that, these financial statements are all right. I know you gave us a report and all that, but can you just come in and talk? You can't do that. You cannot go in and be an advocate for the client. You're supposed to be independent, impartial, unbiased, and you cannot do that if you're advocating for the client. So if they take a very aggressive tax, for most normal tax issues, they want to know what the tariffs are or whatever, yeah, you can do those. But for aggressive or unusual tax positions, you cannot do that for your client because it will turn you into an advocate. Tax services for officers, no and yes. It used to be very common for all the officers of the company that they'll get their taxes done by the CPA firm. So the CPA firm would come in, they'll do the audit, and then for free, they will do all the taxes for the upper management. And it kind of used to be a badge of honor if you were high enough in management that you'd have the CPA firm doing your taxes. But that's no longer allowed for publicly traded companies. If you're not publicly traded, yeah, they can do it. You could, you audit somebody's bakery or something like that, and you may also do their taxes. So yeah, it's perfectly allowed for AICPA. Okay. And that is it. Okay, so we are done with the Chapter 3 ethics handout. And so what I'm going to do next is send out the Chapter 3 hold on. Chapter 3 multiple choice questions. I think these are available in Blackboard now. I'm not positive, but I think they're also available in Blackboard if you're. If you're not in Blackboard. All right, so if you don't have your email, access to your email. Okay, so and just like before, we will do the poll. Okay. Okay, so I launched it. Hopefully you guys will get it shortly. And let me see. Okay, it looks like it went through. Okay, so oops, we don't want that. Hey, we don't want that either. So I'll tell you what, let's go ahead and take a break, and we'll say be back, and you can actually work on these through the break. So let's say, I don't know, 7, be back at 7:10 maybe. And whenever you come back, you can work on these. Answers in. And you get extra credit points, kind of like we did last time. Any questions? Okay. So wait for a few people to turn this in. Not a problem. These are pretty these are pretty wordy questions. Is everyone still working on it still? If you are, it's absolutely fine. You just say you are, or also just put it in chat. I'll leave it open for another couple minutes here, I guess.
Yeah, I'm still working on it.
Okay, all right, no problem. And just give you guys a head up, the next thing we're going to cover is on cash, the cash episode. From here on in, we're going to kind of do a little bit more of, less of the theoretical, that sort of thing, and do more of the actual procedures that you'd be doing if you were doing auditing. Okay, anyone else still working on it?
I am. I'm almost done.
Okay, all right. All right, first one up. A is correct. And this one, it's because they invested directly in the stock. It's a direct interest. Two is A. 3 is C. Getting them all so far. Yes, this is a close family relative, and being the president, they would certainly have influence over the financial statements. They would have influence over the CFO and the controller and the treasurer. Yeah, this is one of the weird things about auditing is the independence. You know, that's not me. Dog. Unlike other professions, like for doctors, lawyers, and all that kind of stuff, if you're a lawyer and your cousin, whatever, comes to you and wants to, there's no independence problem. It doesn't matter. Same with a doctor, you can treat, whoever in your family and all that. It's kind of strange for auditing, in that we must be independent of our clients. Okay, number 6, because they only have one office, that means that the same office is also doing the audit. So any partner in the firm will be in that one office, and a direct financial interest is a no-no. Yep, contingent. Yep. I don't think I talked about professional corporations, what they are. Professional corporation is, there's a problem with having a partnership. If you only have a few people in the partnership, it's not that big of a deal, but whenever a partner comes into a partnership or leaves a partnership, the original partnership is dissolved and a new partnership is formed. So you have partner A and B together. Partner C comes into the partnership. Partnership A and B is dissolved. And starting on the day that C comes in, it's a new partnership, ABC. If A leaves the firm, the partnership's dissolved, and then B and C. Now, for a small firm, it doesn't matter too much. But if you get into a really large CPA firm that may have thousands of partners, it's a real problem, because any given week you might have 2 or 3 partners, that come in or leave or whatever. You'd have a partnership from Monday to Wednesday, and then that's dissolved, and then from Wednesday to Thursday, then that's dissolved, and then it becomes really hard. So what they do, these professional organizations, professional corporations, I should say, they allow to simply give stock to what would normally be the partners. So when you join that professional corporation, you're not actually in a partnership. They give you stock, and now the corporation itself, professional corporation, goes on forever. It's like a regular corporation, whereas only the ownership of the stock is changing. It's for convenience, basically. So following D is correct. Immaterial, indirect. Well, you guys got all of them, so I will download the results. Not there. Not even there. It's funny calling this spring semester. You look outside and it's like it looks like Mount Everest or something. Okay, so what we're going to do now is go into chapter. We'll get a little bit done in chapter 10. So the chapter 10 handout is for cash. And we'll go ahead and get started on it. I don't know how far we'll get on it, but we'll get through some of it. It's kind of, I shouldn't say this because it's going to, you'll be disappointed, but I think it's one of the more fun chapters to go through. Just because there's just so many different facets to it. But anyway, so this is accounting for cash, and very well a little bit. And as we go on, hopefully we get a little bit more of a flavor of kind of how we kind of piece together audits. All right, basically we have 5 general types of accounts that we have in accounting. It's actually pretty amazing that virtually any transaction you can think of will fit into these 5 categories. You know, they're either revenue or expense, or a gain or loss, the same idea. Assets, liabilities, and equity. Those are really it. Which one of these would be the most easy to prove? Which one of these would have accounts that are the most easy to prove?
Assets.
Yep. So that, oops, that's not a number, is it? So this would be the easiest one to prove. I say, well, why? Well, because assets, for one thing, a lot of them you can see that, I'm sitting in an asset. This is being recorded on an asset. The assets are really, inventory is an asset. You can go count the inventory. It's real easy for a lot of assets to prove them. Liking things that are easier to prove, assets are where most audits start at. They'll go through, the balance sheet really gets beat up on the audit. And the reason is that, for one thing, the assets are, usually some of the larger accounts, and also that they are the easiest to prove. So that's why we start with the assets. Now, second, we go to liabilities usually. Oops. I don't need to underline that, do I? So liabilities are usually the second place we go. Now notice something, because assets have to equal liabilities and equity, and these two sides have to equal. Sort of by default, oops, we've proven the equity. So if you prove the assets and then go to the liabilities and prove those out and get comfortable with those, that they're not misstated, well, by default, the equity must be okay, right? If you're okay with the assets and you're okay with the liabilities, since those the two sides, the assets equals the liabilities plus the equity, then the equity must be okay. And if the equity is okay, that pretty much means that the income statement's okay, because the income goes into the equity section. So basically, we really beat up the assets and then also the liabilities in an audit, because that pretty much proves the whole rest of the shebang. or financial statements maybe. But okay, so now we're going to talk about the audit of cash. Often cash is audited to the 100% level. You say, why? First answer to that is because we can. Unlike a lot of other accounts, you can actually audit cash to 100% in most companies. You can get the bank statements. You know, you can see what, even if they have some cash on hand, you can count the cash on hand. It's not that difficult for the most part to audit cash 100%. You can have bank statements, you know, stuff running through the banks. If they have cash on hand, like, you know, for making deposits and stuff, you can count that. So cash is one of those accounts that we can audit 100%. You know, for instance, even Walmart, I don't know how many accounts they have. I'm sure they have hundreds, if not maybe thousands of accounts, but you can get, you know, it may take you a little while, but you can get 100% of their cash accounts. You know, it's not impossible to do. It would be impossible to audit 100% of their inventory. It'd be completely impossible. But even for a huge company like Walmart, you could get 100% of the cash. So one reason is we can. Now, there's more reasons than that. Cash is arguably again, I'm listening something hard. Need an arg. Nice steal. Oh, I know to misappropriate. You know, everybody can use cash. And you know, it doesn't matter what company you're in. Maybe if you're in a company that makes lawnmowers, maybe you don't want a lawnmower, you live in an apartment, you know, but so stealing a lawnmower wouldn't make any sense, but stealing cash, anyone can use it. Okay, well, cash itself might be immaterial. And coming down here, so if we're looking at the assets, let's say that we are looking at the cash account. Well, notice something that, okay, what affects the cash? Okay, well, revenues, right? If someone pays in cash, that's going to affect the cash account. Or if you pay cash out for expenses, right, that's going to impact the account. So you may have a direct let me do it the other way around, actually. So you may have, if you have cash expenses and revenues, they'll directly affect the cash account. You say, well, wait a minute, what if they don't pay cash? What if they do it on account? Okay, goes on accounts receivable. Accounts receivable eventually gets turned into cash. Say, okay, well, what about expenses? I may not pay it right away. Okay, it'll look like this. What do liabilities get paid with? You get paid with cash. And the same thing goes for inventory and so on and so forth. So, you can prove out the revenues and the expenses pretty much 100% going through the cash account. So while cash is, like I say, oftentimes it's immaterial on the financial statements. You look at, they'll have, whatever, 10 million in cash and have billions of assets. But you go, okay, well, that's not material. Well, it's not material. The transactions that flow through it are. And if you can prove out the revenues and the expenses, you just proven the income, which is probably arguably the most important number that you're going to audit towards, is that income. Make sure that income is fairly presented. So while cash itself, not that big a deal, looking at it statically, but the transactions that flow through there. So one of the reasons why we also prove out cash is that it's connected to so many accounts that are can be very material. Okay. And all, dividends comes through there. If you prove these two, you proved out the net income. It ends up in the equity section. Any liabilities. Oh, wait a minute. I got the same with the wrong one here. Now they're on top of each other. Okay. So, yeah. It is connected to so many accounts, long-term accounts, inventory, where you buy inventory, it goes into accounts payable, you pay the accounts payable, it's all connected to it. So there are so many accounts that are connected. Virtually every account is connected to cash. In fact, you almost have to really try to come up with an account that won't have some impact on the cash. If you have ownership, what do they pay you for the stock? They pay you cash. If you think of something, you can think of something strange, like, okay, if someone donates land for stock, for stock, ownership stock for, and they donate land, that's about it. There's not too much else that would do it, because even if you say, okay, they donate a building or equipment, well, the building or equipment's going to have tax ramifications, and that's going to come out to be cash. It's almost difficult to come up with a transaction that wouldn't go through cash. Okay, segregation of duties. Now, this is not just for cash, this is for anything. We remember it by car. I'm going to do something else here. This is also known as incompatible duties. Custody of assets. I'll kind of go through examples here in a second. Authorizations. And record keeping. Is that 2 words? I don't know. So this is our car. And so these must be separated for good control. So custody of assets, whoever has the asset, they, they cannot have the authorization or the record keeping duties. If they authorize transactions, then they can't have the other 2. They can't have custody of the asset or record keeping, and record keeping can't do any. But for example, custody of assets, say, he's a treasurer. Oh, I left off an R. So the treasurer of cash. The treasurer can has the cash accounts. Record keeping, accounting. So the treasurer has custody of the cash. And the accounting department, besides misspelling reconciliation, they will have the responsibility of doing the bank reconciliation. That's the record keeping. Someone in management might say, well, why don't you have Treasury do the bank reconciliation? They're the ones that deal with the cash, have them do the bank reconciliation, because the bank reconciliation is all about cash. Why don't you have them do it? Because they have custody of the accounts. They can open the accounts, close the accounts, move them around, write the checks, all that kind of stuff. You have to have somebody on the outside doing the record keeping. If you combine both those 2, well, they could take the cash and then make it disappear on the books too. So we try to keep things separated, and when you run into a problem, it almost always comes down to this, that there are 2 or more of these that are overlapping, that someone has more than one of these duties. So these are called, this is under the heading segregation of duties. These are also called incompatible duties, that you shouldn't have these these overlapping. And almost without exception, in some ways this breaks down whenever you have a problem of fraud or something along those lines. Is someone having more than one of these? Okay. We'll go through this cash receipt. Just kind of walk through this for a second. This shouldn't take too long. So this is kind of the flow of what happened. How does the company receive cash? Cash coming into the place, the collection of cash. And when I was going through, when I first started in college, I got a job at a bank working in the mailroom, and I did this. I had no idea I was going to be in accounting. Quite honestly, I was going to try to be a welder back then, but so I got this job, and I did this. And so what happens is the checks would come in, and me and this other guy would open the checks up, and make a list of it. And so that's what you're going to see here. So someone sends in their check. So this is their check that they sent in. Oh, that looks bad. So this is their check. They send it in. It goes into the mail room. Me and a guy by the name of John Barnes would count that. So it goes into the mail room. Oops. And they make a list of the checks, and they make 2 lists of them. So it goes in the mail room. We open the checks. We actually had a machine that did open the checks for us. It was actually kind of a dangerous machine. It had a spinning razor blade thing on it, but anyway. So the checklist, it goes, we made a checklist out, and it would go to 2 different groups. We would send one to accounts receivable. Now, accounts receivable, that's bookkeeping, that's record keeping, right? We do not give them the checks because they have record keeping. You can imagine if we give them the checks, they could take one of the checks for themselves and then write off the account. Yeah. So we don't actually give the checks because that's an asset. We don't give that to accounts receivable. They're record keeping. But they will get a list. They'll get the list of it, and that's the people checks that they come in. So they will apply that to the account. Okay. The second list, along with the checks themselves, we'll go on here. Now notice that they get the actual checks. Now they're not making the record. They're not doing the record keeping. They're getting the checks, and there's a check list. Now, let's suppose someone in the mailroom, some future accounting teacher perhaps, decided to steal one of those checks. I'm going to take one of the checks. Okay, now there's 2 choices. Now, the stupidest thing you could do is steal the check and then put it on the checklist, because when it gets to the cashier is going to say, "Where's this check?" So you'd have to keep it off of that checklist, and then whoever paid that money is gonna contact the bank and say, "Well, wait a minute, I already paid that," or contact the client and say, "I already paid that. Here's the check. Oh, where was it canceled? Oh, at a 7-Eleven store. Hey, there's a 7-Eleven store right by your house, Mark." But anyway, so if someone in the accounting room, and first of all, we always had 2 people in there, and that's it's a very common control. Because it's much more unlikely if 2 people are if you have let's say that why would you have more than 1 person? If 10. Okay. Let's say that I am so sorry. Okay, here we go. Okay, here's an employee in the room, and let's say that there's a 10% chance that they are going to do something illegal. Okay, let's say that just in general, people that if there's a 10%, we'll make them a happy person. There's 10% chance that they're going to do something illegal. If you put 2 people in, you'd have to have both people involved. So if you have 2 people counting, and if each of them has a 10% chance, the likelihood that both of those are going to be people who would take, it has changed from a 10% possibility down to 1%. And actually, it's probably even less than that. It's probably even less than 1% because you'd have to have them have the courage to tell the other person, hey, I feel like stealing some money. So it's very unlikely that, you have 2 people and they're counting it. A management person would say, wow, that's inefficient. You shouldn't do that. Just, one person can count the checks, but it's, as a control, it's a good one. Okay, so what does a cashier do? So the cashier gets these checks, and they will put them in the deposit. Okay, so here's the check. Here it is going into the deposit. Here's the total deposit going in to the bank. So they make the deposit goes into the bank along with any other deposits. Okay. If there's a problem with a check, someone says, okay, I sent you that check, on this date. Are you going to be able to find that check in the bank statement? Will you be able to find it over here? So someone says, go ahead.
No, you can't, because it's not the individual amount.
That's exactly right. You can't look at the bank statement because, the check will have been deposited. It won't be on the bank statement itself. It'll just show the total for the deposit on there. So you can't actually find it. Now, where can you find it? You can find it in the deposit slip. And you write on the checklist. So if someone says, wait, I sent that in, you don't look at the bank statement, you look at the checklist and the deposit slip, and they should be on both of those. And if it's not, then there's a problem somewhere else in here. Okay. Oh, yeah. It's going to be verified bank statement. Okay. Oh, yeah. Okay. And by the way, the same thing that holds true up here, that, one of the checks that you'll do is, do all items on the checklist go into the deposits, into the bank. So anything that's on the checklist should also appear here down below. So, but let's just look a couple of questions here, then we'll call it a day. If an auditor needs to confirm the customer has submitted a check to the client, which of the following documents would most likely, would the auditor most likely examine? We just talked about. The checklist or the deposit slip, and actually you probably look at both of those, because if it's missing on the deposit slip, that means that probably the cashier took it or misplaced it or whatever. But looking at the bank statement, you're not going to find anything. In the accounts receivable journal, the problem with the accounts receivable journal is that if the check was lost before then, you might think that it was never sent in, where it may have been sent in. It just, for whatever reason, didn't show up on the list. All right. If a customer's check, cash check was missing and it did not, I didn't word this one very well. And up here on the checklist, who likely misappropriated, stole the check?
A.
Yep. Yep. A accounting room employee. Okay, let's stop there. Okay, so what I'm going to do is send out the chapter 3 exam, and it'll be due not tomorrow, but the following Friday. And if you have any questions on it, you can feel free to contact me. But I should be sending that out in, I don't know, probably like 5-10 minutes or so after class, and it'll be in your email account. And then there's already the assignment's already set up in there, so hopefully it'll be a problem with that. Any questions? Okay, and that's the only thing for next week is to send in the or what did the exam and then the 2 handouts. These 2 handouts, there's a will be in the submittal things. No, that one won't. Not that one won't. The chapter 3 will be in there, and then the exam will be in there. So those will be in the submit stuff here. Okay, any questions? Okay, your exams will be in your mailbox in, well, let's say 10 minutes, but hopefully even sooner than that. Okay, have a good weekend. Sorry for the weather. I'm not sure what's going on out there. It looked like the North Pole when I looked out the window earlier, but anyway, I will talk to you guys in a week's time. Have a good evening.
Good night.
Thank you.
Okay.